In January 2010, Brian Moynihan inherited a bank that was on life support. The financial crisis had just ripped through Wall Street, and Bank of America was sitting on the toxic wreckage of two of the worst acquisitions in banking history, Countrywide and Merrill Lynch.
16 years later, Bank of America is worth $360 billion. It has the largest domestic deposit franchise in the United States at $1.2 trillion, 57 million digital users, and an AI assistant that has handled over 3 billion customer interactions.
And right now, in April 2026, something interesting is happening. The Fed is holding rates steady, regulatory capital requirements just got loosened, and BAC's own AI, called Erica, is quietly transforming how a 213,000-person bank operates. Earnings drop next week on April 15th.
The question for investors is whether Bank of America can finally close the valuation gap with JPMorgan Chase. At 10.8 times forward earnings versus JPM's 13, the market is pricing BAC as a second-tier bank. But the fundamentals say otherwise.
This is episode 75 of Charged Alpha, our deep dive into Bank of America Corporation, ticker BAC. Let's get into it. Bank of America was founded in 1904 and is headquartered in Charlotte, North Carolina, with about 213,000 employees. It's the second largest bank in the United States by total assets and serves roughly 68 million consumer and small business clients.
The business operates across 4 segments. Consumer banking is the bread and butter, retail branches, checking accounts, mortgages, auto loans, and credit cards. Global wealth and investment management is anchored by Merrill Lynch, which manages $4.1 trillion in client balances. Global banking handles corporate lending and investment banking, and global markets covers sales, trading, and research.
What makes BAC different from, say, a Goldman Sachs or a Morgan Stanley is the sheer scale of its consumer deposit base. $1.9 trillion in total deposits, with $1.2 trillion domestic. That's the largest in U.S. banking. And deposits are the cheapest form of funding a bank can have. They're basically free money that customers leave sitting in their accounts.
And the digital transformation has been remarkable. 57 million verified digital users. Erica, their AI assistant, launched in 2018 and has now surpassed 3.2 billion client interactions. The 2.0 version, what they're calling agentic AI, can handle 98% of basic customer inquiries and is reducing back-office processing costs by about 15% in the retail segments.
The moat here is layered. You have the deposit franchise creating cheap funding, switching costs, keeping customers locked in across multiple products, massive scale spreading fixed costs, and now technology creating a new kind of barrier. A fintech can build a slick app, but replicating 1.2 trillion in sticky deposits is a different story entirely. Let's talk about the man running the show. Brian Moynihan has a BA in history from Brown, where he co-captained the rugby team, and a law degree from Notre Dame. He started in corporate law before joining Fleet Boston Financial, which Bank of America acquired in 2004. He rose through the ranks as general counsel and head of investment banking before getting the top job in January 2010.
When he took over, BAC was hemorrhaging money from the Countrywide mortgage disaster and struggling to integrate Merrill Lynch. Moynihan's approach was methodical. He implemented $8 billion in annual cost cuts by 2015, shed non-core assets, and built what he calls the responsible growth framework. The idea is simple: grow market share profitably, manage risk tightly, and return capital to shareholders. Under that philosophy, he's delivered 27 consecutive quarters of net consumer account growth. His 2025 compensation was $41 million, up 17% year over year. Wall Street views him as a steady, pragmatic operator, not flashy, but effective.
All right, let's dig into the financials. BAC at $50 with a $360 billion market cap. The trailing PE is 13 times.
That's cheap by any measure. The forward PE drops to 10.8 times, and the PG ratio is 0.84, below 1, which signals the stock is undervalued relative to its growth rate. For a bank generating over $113 billion in annual revenue, this is a bargain valuation.
Dividend?
2.2% yield. with a $1.12 annual payout. BAC has been steadily increasing the dividend, and with the new regulatory relief freeing up capital, the payout could grow faster from here.
Revenue trajectory.
Full year 2025 was $113 billion, up 7% year over year. Net income grew 13% and EPS hit $3.81, up 19%. The quarterly progression shows stability. Q4 2025 came in at $28.4 billion. Net interest income was $15.9 billion in Q4, up nearly 10% year over year.
Balance sheet metrics.
CET1 ratio of 11.4%, well above the regulatory minimum, and that's before the March 2026 reproposal that reduced capital requirements by about 5%. Efficiency ratio of 61%, down 2 full points year over year. Return on equity of 10.7%, and book value per share of $38.44. The tangible book is $32.67, meaning the stock trades at about 1.5 times tangible book. Overall, financial health is strong. Capital ratios are robust, efficiency is improving, NII is growing, and the regulatory backdrop is turning more favorable.
The analyst community is solidly bullish. Strong buy consensus, 18 buys, 4 holds, and 0 sells out of 22 analysts.
The average price target is $58, with a range from $53 to $71. That implies about 16% upside from current levels. The highest targets are coming from analysts who think the investment banking rebound and AI-driven efficiency gains are being underpriced.
Notable calls?
Morgan Stanley has an overweight at 64, arguing the NII growth trajectory is underappreciated. TD Cowen is at buy with 64 as well, focused on Erica AI and operational leverage. Evercore ISI is at outperform with 59, emphasizing regulatory tailwinds unlocking capital returns.
And last earnings?
Q4 2025 reported January 14th, beat on both lines, EPS of 98 cents versus the 96-cent consensus, and revenue of $28.4 billion versus $27.55 expected. Net interest income came in particularly strong at $15.9 billion, about $240 million above estimates. The stock actually dipped after earnings because 6 analysts trimmed their price targets slightly, but 0 downgrades. The guidance for 2026 is 5 to 7% NII growth, 200 basis points of operating leverage, and mid-single-digit loan growth.
Bull case. Number 1. The investment banking rebound. M&A and IPO markets are showing what some analysts are calling supercycle signs in early 2026. BAC's global banking division is positioned for double-digit fee growth as deal-making activity hits levels not seen since before the pandemic.
Number 2, AI-driven efficiency gains. This is the sleeper catalyst. Erica 2.0 is already cutting back office costs by 15% in retail segments. Management is targeting 100 to 200 basis points of efficiency ratio improvement over the next 24 months. If they hit 60% down from 61 today, that's hundreds of millions in incremental profit dropping straight to the bottom line.
And number 3, the wealth management flywheel. Merrill Lynch is managing $4.1 trillion in client balances, a record, and pulled in $100 billion in net new assets in 2025 alone. This is high-margin, capital-light revenue that compounds over time. As demographics shift and millennials inherit wealth from boomers, BAC's wealth platform becomes even more valuable.
Now the bear case. Number 1, interest rate sensitivity. Bank of America has one of the most rate-sensitive balance sheets in banking. A 1% decline in rates could hit earnings by roughly $2 billion. If the Fed cuts faster than expected, NII growth stalls, and the whole thesis weakens.
Number 2,
credit quality. The labor market is cooling and inflation remains sticky. Net charge-offs are trending upward. If the economy slows materially, loan losses accelerate and eat into the earnings growth. Banks are cyclical, and BAC is no exception.
and the third bear argument.
Regulatory and structural risks. There's a proposed 10% credit card interest rate cap that could materially hurt consumer banking profitability. And here's the wild card that doesn't get enough attention. CEO Moynihan himself flagged on the Q4 earnings call that if regulators allow stablecoin issuers to pay interest, Bank of America could face a potential $6 trillion deposit outflow risk across the industry. That's existential level disruption if it materializes.
Let's stack BAC against the big bank peers, JP Morgan Chase, Wells Fargo, and Citigroup.
JP Morgan is the undisputed heavyweight. It trades at 14.7 times earnings with a 2% yield and consistently delivers higher ROE. BAC's discount to JPM, about 2 turns of PE, exists because the market views JPM as best in class. But if BAC's efficiency gains and NII growth continue closing the gap on returns, that valuation discount should narrow.
Wells Fargo?
Wells trades at 12.3 times the 2.1% yield. It's still hampered by the asset cap from its fake account scandal years ago. Lower efficiency than BAC and more regulatory overhang. BAC is the clearly better positioned of the two right now.
Citigroup? Options on BAC are sending a mixed but interesting signal. Volume-based put-call ratio is 0.39, very bullish, meaning traders are buying more calls than puts.
But the open interest tells a different story. The OI put-call ratio is 1.14, which leans bearish and suggests institutional hedging. Implied volatility sits at the 30th percentile, compressed and below the 52-week median. That's important because low IV heading into an earnings catalyst on April 15th means options are relatively cheap. Call clusters at $52, $55, and $60 suggest traders are positioning for a move higher post-earnings.
Insider activity at BAC is exclusively selling over the past 12 months. 0 buys and 5 sells.
The largest transaction was President of International Bernard Mensa selling 94,000 shares at $46.94 for $4.4 million. Over the past 3 months, insiders have sold approximately 492,000 shares total. While the volume is notable, this is consistent with diversification at elevated prices rather than a loss of confidence. Insiders at large banks routinely sell as compensation vests. What would be more concerning is if we saw insider selling accompanied by analyst downgrades, and we're seeing neither.
What are the key dates and metrics investors should track?
3 things to watch. First, Q1 2026 earnings on April 15th, just 1 week away. The market needs to see the 5 to 7% NII growth guidance validated, and commentary on credit quality trends will be critical. Any uptick in net charge-offs or provisions will spook the market. Second, the Fed's rate path. BAC's earnings are directionally tied to interest rates more than any other mega bank. If the Fed signals additional cuts beyond the one currently expected for 2026, BAC underperforms. If rates stay higher for longer, BAC benefits disproportionately. Third, watch the efficiency ratio. The 60% target is the key metric for the AI-driven transformation thesis. Every 10 basis points of improvement translates to meaningful earnings accretion.
Here's the bottom line. Bank of America under Brian Moynihan has transformed from a crisis-era mess into a disciplined, tech-forward financial services machine. The numbers tell the story. 19% EPS growth, improving efficiency, growing NII, and the largest deposit franchise in U.S. banking.
At 10.8 times forward earnings with a 2.2% dividend yield, BAC trades at a meaningful discount to JP Morgan despite improving fundamentals. The PEG ratio of 0.84 says the stock is undervalued for its growth rate. Regulatory tailwinds are freeing up capital, Erica AI is driving real efficiency gains, and the Merrill Lynch wealth platform is compounding at record levels. The main risk remains interest rate sensitivity, but with the Fed holding steady and only 1 cut expected, the environment favors BAC's earnings trajectory.
The metric to watch is the efficiency ratio. If it breaks below 60% over the next year, Bank of America will have proven that AI can structurally improve bank profitability, and the market will re-rate the stock accordingly.
Brian Moynihan put it simply on the Q4 earnings call. If the companies of America employ people and pay them a little bit more, they will spend, and the economy in the U.S. will be fine. That's not just optimism, It's a statement from the CEO sitting on $1.2 trillion in domestic deposits, watching how 68 million customers actually behave with their money every single day.
Great stuff. That's going to do it for episode 75 of Charged Alpha, our deep dive into Bank of America Corporation, ticker BAC. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.